We continue with our discussion on working capital analysis, and in this particular section we're going to talk about the perspectives that we need to be careful about while looking at working capital of a company, right? So far we have established that ideally a company should have negative working capital, if not negative, because negative is only possible for B2C companies, which are dominant companies or big companies, then they should at least have stable working capital. On the other hand, we've also studied that current ratio, which is current assets by current liabilities. A lot of the textbooks suggest that this should be greater than 1, which basically means that we should have positive working capital. Now, when you combine these two thoughts, some part of our discussion says negative is better, some part of our discussion says positive is better, and that's where essentially it is important to understand from whose perspective are we looking at this entire problem. Who is it for whom this analysis is being done, right? So let's understand. A company would always want to have negative working capital, right? That's what the owner of the company would want, or the owner of the business would want, since they end up using someone else's money. Who's the someone else? Either the supplier, because you have not paid money to the supplier, so there is a payable outstanding, or the customers, right? You may have some sort of an advance taken from the customer. Both of these are current liabilities. A negative working capital scenario would have current liabilities such as payables and customer advances as high. And that's essentially great for the business owner because the business owner thinks he or she is running the business at the expense of someone else's money. They're not using their money at all. However, if you're a bank, right, someone who's lending to this company, then you may want to safeguard your position or your cash flows, and hence you may seek a positive working capital. So if you're a bank who's giving money to this company, you will ask this company that, look, if I give you a short-term loan, how are you going to repay it? How are you going to repay it? Right? And it is in this context that the perspective on who is looking at the working capital becomes important. Remember, decision making in working capital context may also always entail some sort of a risk. We'll discuss about this risk in a minute, but whether you are looking at it from the perspective of the owner of the business, or you're looking at from the perspective of another stakeholder like a lender to a business, it depends on whose perspective is defining what kind of working capital requirement you might want to have, right? And it is always important to understand all these perspectives because perspectives are being built based on what is the risk idea or risk perception or risk objective of the party involved, right? Now, let us also understand that even if you're looking at it from the perspective of the owner, there is a finite amount of risk that is involved in deciding to have negative working capital, right? Let's understand this. Now, we say negative working capital is going to be kind of similar to low level of current assets. So this is essentially what we are saying as negative working capital. High level of current assets, on the other hand, is essentially going to be something like positive working capital. Now, if you have negative working capital, what does that do to the liquidity of the company and what does that do to the profitability of the company? We know that if you're thinking from the owner's perspective, you would have a higher profitability in a negative working capital scenario, right? So negative working capital is desirable because it gives you higher profits. You work on someone else's money and also gives you better cash flow, right? On the other hand, if you have positive working capital, your profitability would be lower, right? So that's the first element of the entire equation. But at the same time, remember that it creates a risk in terms of low liquidity, which means you don't have money at any given point of time. While it is desirable, you do not hold any short-term assets practically. So if things go wrong, if there is a big liquidity risk at some point of time, then it becomes a dangerous ploy to have very low negative working capital, very negative working capital or low amounts of current assets into the system. On the other hand, if you have positive working capital or high level of current assets, then the liquidity position is extremely high. What is important is that it should be known whether it is by choice that the decision is being made. This choice is a very, very strong element because if you have a high level of current assets by choice, you can reduce it, but you want it because you want a better liquidity, then that's fine. If you have high current liabilities by choice, which is negative working capital by choice, you can reduce it if you want, but you don't do it because you can have that kind of control over your suppliers. That's fine. But without the choice element, which is without the owner deciding what working capital has to happen, if the working capital comes in without the owner deciding, that's going to create a problem. Nevertheless, negative working capital has been perceived as a slightly high risk scenario. It is fine in B2C businesses because typically your demand is kind of consistent and hence, you'll keep getting cash day after day. So if you're an Amazon or a Flipkart, it's not like an immediate cash flow trouble is going to create a lot of problem to you because tomorrow you'll get more orders, more cash around it. But if it is a B2B business, then the risk could start becoming bigger in terms of low level of current assets, right? High level of current assets make this risk low, but on an ongoing basis, it will start having an impact on profitability. So you can choose to keep a lot of inventory. You can choose to keep a lot of inventory, but that has a cost, which will reduce the profitability to a lower level. But at the same time, it reduces the risk also to a lower level, for example, right? So it's important to understand from whose perspective are we looking at the working capital. And within that, the decision making is almost always on a question of your liquidity preference or the risk you carry there versus the profitability risk, right? Take an example. Take an example of a company like Maruti. Now, Maruti maintains a very low inventory, right? That's a low level of current assets. So they have low liquidity. They have high profitability because of that. They have made this conscious decision that we will keep a low inventory. What is the risk? In an event that their plant shuts down. So if there is a shutdown in the plant, they run out of volumes after about 7 days because they don't keep inventory. So if there is a shutdown in the Maruti plant for more than 7 days, Maruti will run out of car volumes to be sold in India. That's a risk because once in 4 or 5 years, you may have some event that shuts the plant down, and that's a liquidity kind of a risk for you. But the evaluation parameter for Maruti is that do you risk, do you keep a higher inventory just for those 7 days of risk, or do you keep a low inventory for the 5 years of operation in which the risk will materialize probably only once, right? So that's a live decision that a company has to make. That's a business decision that the company has to make. And there is no right or wrong here. Some companies may choose to say that we want to keep the inventory because we don't want to take that risk at any point of time. Some companies might choose to say we will take that risk. There's a finite risk that I will lose some sales once in 5 years, but for the entire 5 years, my profitability will remain high. That's a decision that the company has to make, and two companies can make those decisions and run businesses on their own, right? We do need to check at any point of time that we said working capital should be stable, right? Even sporadic jumps and stable as percentage of sales, right? So sporadic jumps or dips are not a problem. A consistent rise or decline may be symptomatic of serious concern. So that's a caution that we have to be careful about. If there is a consistent rise, let's understand the rise part first. A continuous increase in working capital may imply that there are piling inventories. The firm is not able to sell what they're producing. That's a possibility. Or extension of credit terms to buyers in order to boost sales in a difficult business environment, which means receivables are going up. You're basically telling your buyers that, look, you can buy the stuff today but pay later. Now, that may increase sales in the short run, but that adds an element of risk. So, if your working capital as percentage of sales keeps going up continuously, that's a problem. If it keeps going down, working capital as percentage of sales, someone might argue that positive is becoming less positive or positive is becoming negative. That might be good. But remember, we again go back to the concept of choice. If you can establish that the company is taking working capital down on their own terms because of their choice, that's fine. It's also possible that the business does not have enough money to pay off the suppliers on time and thus is trying to get payment terms relaxed. So current liabilities are going up not because of choice, but because of the force that you don't have money. Remember the example of Kingfisher Airlines, right? Now, essentially, current liabilities went up not because they wanted to have negative working capital, but because they did not have money to pay the suppliers, right? That's the important part. That sporadic jumps and dips are fine, but a consistent rise or decline, there should be a question mark on the entire problem. So you do need to check. Ideally, you want negative working capital, then you want stable working capital, and you want to check if there are any kind of consistent rise or decline. If there is a rise or decline, check, right? That's your standard operating procedure whenever you're analyzing the working capital of any particular company, right? Now, we also remember that when we did our formula calculation, instead of doing CA minus CL, we were practically using for all parts non-cash current assets minus current liabilities. So we were using inventory, we were using receivables, but we were not using cash, right? Why did we exclude this cash? So there are multiple reasons, and we'll take a look at the reasons. The first one is that it is the amount required, remember the keyword, to be funded by the business in order to run day-to-day operations smoothly. Cash is not needed to be funded. Cash is already there. So cash is already available. You don't need to fund it. You only need to find out what is the amount of money that is blocked in the business, and that's non-cash current assets minus current liabilities. That's reason one. Reason two, typically when you look at working capital analysis, you want to find out how good is the firm in managing receivables, how good is the firm in managing inventory, how good is the firm in terms of managing payables, right? Individual components, how good is it in managing these three? When you use cash, sometimes cash can overpower that analysis. We will look at an example of this in a moment, right? And the third point is that cash requirements, in fact, should come out of working capital analysis. Remember when we were building the cash flow statement using the indirect method, we start with the net profit, we add depreciation, we subtract any capital expenditure if the company is spending anything on infrastructure building or adding plant and machinery, and then we subtract any change in net working capital to get what? To get the cash flow. The cash flow gives us the cash number. Now, if I use cash in calculating this, how can I use cash in calculating this when I'm going to get cash from this analysis? So the order is that working capital gives me cash, and it can't be the other way around, because then there is a problem. You need cash to calculate working capital, and you need working capital to calculate cash. So that's the third reason why you remove it, right? Let's understand this. Let's understand reason two first, where we say that cash can overpower that analysis. For a minute, Assume we are doing CA minus CL, right? Assume that the formula we are going to use is CA minus CL. Look at the total current assets, loans and advances, total current liabilities and provisions. That's CA minus CL, net current assets, right? Now, that's the working capital. If I use CA minus CL as the formula, including cash, what's happening to working capital as a percentage of sales? The number, which was 29%, went all the way up to 51. This is bad, right? And then 51 went all the way down to 22. This is good, right? Because working capital as a percentage of sales declining, maybe that you're having lesser receivables, lesser inventory, etc. Is that so? Is that actually the case here? Let's decode this a little bit further. Now let's try and do the same analysis removing cash, right? So we also calculate non-cash CA minus CL. That value comes here. We find that what was essentially negative working capital for the firm, this is non-cash CA minus CL as percentage of sales, has become positive. Now that can't be good because this we have read is a negative flag for the company, negative working capital becoming positive. So what is happening? If you look at this company, they have two headers in cash and bank balances and fixed deposit. They have about 22,000 crore of cash and another 280 crore here. So roughly about 22,500 crore of cash that they have used up. So this becomes zero. And now they have about 6,000 crore of cash left. So how much? 22,600 crore minus 6,600 crore, which means they have used up 16,000 crore of cash, right? The cash has been used up. Because cash has been used up, you find that if you are using the total formula of CA minus CL and not non-cash CA minus CL, you find that that number has gone down from 51% to 22%. That's because you've used up the cash and the cash has gone and moved towards fixed assets to build up capacity. If you look at other components with almost a 10-15% jump in sales, look at what happens to inventory. Inventory was 9,000, that became almost 14,000. So sales go up by 10%. How much does inventory go up by? Inventory goes up by almost 50%. That's a problem because inventory as a percentage of sales would have increased dramatically. What's happened to receivables? Receivables is this sundry debtor number. That's 3,600 become 4,800. What's happened to receivable? Receivables have gone up by 33%, right? So sales are going up by 10%, but these numbers are going up significantly more. That can't be considered good. That is a negative event, right? Because non-cash working capital requirements are going up, and that's negative. But if you use CA minus CL directly, that's what we discussed. That's what we said, that cash can overpower the analysis. Cash might start distorting the overall analysis. Our purpose is to check whether receivables, inventory, and payables are doing well. Cash can create a problem there. So that's why we remove cash. And the third bit was cash requirement should come out of working capital analysis. Take this example. A business is planning a capex of 1,000 crore next year, right? It's planning a capex of 1,000 crore next year. Receivables are expected to increase by 400 crore. What does that mean? Money blocked in the business. Payables are expected to increase by 200 crore. So that's money released by the system. They are expecting a profit of 300 crore, right? Let's assume this is cash profit is what they're expecting. What is the cash requirement? So they are going to get plus 300 on account of point 4, which is this one. We've taken care of that. Payables are going to increase by 200, so that's going to add 200 because cash is released to the system. We have taken care of this. Receivables are going to go up by 400, that's going to block 400, so we have taken care of this. And capex is 1,000 crore, so we have taken care of this. That's the amount of cash needed. So that's minus 1400 minus 1200. So that amount is minus 900, what we see. So the company needs to hold at least 900 crore of cash. Note how we found the cash requirement from working capital analysis. What was the working capital analysis here? What's happening to receivables? What's happening to payables? That is the working capital analysis, and that gave us the cash requirement, right? That's how and why we remove the cash from our calculation of working capital. That's an important parameter to remember. From now on, whenever we use the term working capital, that's going to use the formula non-cash CA minus CL, right? So that's it in this particular section. Couple of questions as you end this particular section. Why do we not use cash in calculating working capital requirements? And explain that how the perspective of an owner of a business differs from that of a banker while looking at working capital.